Hello there, Mark Anderson here, nationwide mortgage banker for Paramount Bank, here to present this week's mortgage rate update, where I tell you what's going on with rates right now, what's likely to impact them in the future, and I'll provide some recommendations as far as what you should do when it comes to deciding to lock your loan or to wait based on your risk tolerance. Rates this week, according to Freddie Mac, 2.87% on the 30-year fixed mortgage. That is up 0.1 of a percentage point from the previous week at 2.77%. If you got a quote the week of August 5th before Thursday, and you got another quote today, you're probably going to see a 0.125% increase in the offered rate. What happened to cause the rates to go up and what might happen in the future to cause them to move one way or the other? This is the 5-day view of the mortgage bond prices. If you're a fan of low rates, you want to see high mortgage bond prices. And on Monday, we're starting out with a relatively strong looking price as this compares to the rest of the graph. But this right here is actually worse than where the bond prices were at on Friday. And what you see throughout the week is a slow but steady decline in the mortgage bond prices. This, in my opinion, seems to be a result of the better than expected unemployment figures that came out at the end of last week that just kind of continued to cause bonds to sell off day after day after day. Now today, something kind of unexpected happened. There was a report that came out called the Consumer Sentiment Report. Now this is normally seen as like a pretty soft economic report. This isn't as weighty as something like the CPI report or the unemployment reports that come out. This is, it's a survey of people's opinions as far as how they feel about the economy. Now, the reason that this, I think, did have some impact is that we had the worst consumer sentiment report that we've had since 2011. So sometimes a softer report, if it's a huge magnitude type deal, can move the market. And in this case, it looks like it was at least partially responsible for some increases in the bond prices today, which is certainly encouraging to see. The big question, of course, is what's going to happen going forward. As I have indicated over the last couple videos, I really do think that we are going to be in kind of a teetering pattern over a fairly narrow range, maybe an average 30-year fixed rate between 2.75 and 3%, and it's going to get bounced around depending on the various pieces of data that come out. The market does appear to be kind of on a hair trigger, so good news about the economy makes rates work. Bad news about the economy maybe makes rates a little bit better. But overall, nothing of serious consequence is going to happen until the Federal Reserve weighs in. The Consumer Price Index report came out on Wednesday, and it basically fell in line with what was expected, which means that the various trading strategies in the bond market and in the stock market, they were kind of accounting for the amount of inflation that was reported. So I'm going to argue that it didn't really move the market in either way. The main consequence of that report relates to the Federal Reserve. If it had come in really, really bad, worse than expected, it would have put more pressure on the Federal Reserve to stop purchasing the mortgage bonds. This is being referred to as the tapering of that bond purchasing program. The reason it's called a taper is that they're not expected to just pull the plug out. Their plan is to slowly taper their purchasing of the mortgage bonds. There is a retail sales report coming out on Tuesday the 17th. It's expected to come in slightly negative at negative 0.2%. What you want to look for here, again, as the rule of thumb goes, good news for the economy, so a higher retail sales figure, particularly if it's in the positive range. That's not going to be good for us on mortgage rates. If it comes in worse than expected, that could be another piece of data on top of that really bad consumer sentiment report that maybe could push the rates back down a little bit. Next up on Thursday, we have the Philadelphia Fed Biz Index. They don't actually use the word biz, but you get the idea. What this is, it's I don't want to compare it necessarily to the Consumer Sentiment Index, but it is a somewhat informal survey of folks representing the manufacturing industry. And my understanding is the way that it goes, it's always labeled as a voluntary survey, which kind of makes me wonder what an involuntary survey would look like. They call up these various manufacturing interests and they say, hey, how are things going? Are they better than the last time I called you, or are they worse than the last time I called you? They're expecting a score of 25, which means that more often than not, the people they're talking to are saying, yeah, the manufacturing business is better than it was the last time I talked to you. If the number is much greater than expected or much better than expected, I think that really could be a market mover in a bad way for us on the mortgage rate side. And likewise, if it comes in significantly worse than expected, maybe that could help us out. All right, my recommendations going into next week, if you are facing a decision of whether to lock your rate or float. If you have a low risk tolerance, I'm going to say lock. I think there's maybe some chance that the rates get a little bit better. Again, I think we're teetering here. There's not going to be any big dramatic swings. But if you've got that low risk tolerance, hey, if you like it, lock it. These rates are great. Just lock. Next up, if you have a moderate risk tolerance, I'm actually going to recommend that you float. I'm going to say you at least float into Tuesday. When that retail report, the retail sales report comes out, look at that and use that to dictate your decision. Check in with your mortgage banker. Hopefully that mortgage banker is me, but whoever it is that you're working with, check in with them on Tuesday, see how that report maybe impacts mortgage rates and use that to make your decision from there. Now, your high risk tolerance folks, the gamblers, you definitely want to float into next week. With those two reports, I definitely think that we could see a snapback to the best levels that we saw 2 to 3 weeks ago. I think the chances of that are relatively small. But if you have that mindset of having that high risk tolerance, I certainly think it's maybe worth a shot. All right, well, thank you so much for watching this rate update. I look forward to talking to you again soon.